Welcome to The Explainer. I am absolutely thrilled you're joining me today because, well, we're tackling something that can literally make or break a contracting business. We are going to master the complex, and let's be honest, sometimes really frustrating process of buying heavy equipment. Think of today's explainer as your ultimate strategic playbook. We're going to take what is often a stressful gamble and transform it into a calculated, highly profitable business move. So I have to ask, what is the true cost of your next big equipment purchase? And I don't just mean the sticker price. I'm talking about the hidden, potentially devastating costs of getting it wrong. The really high stakes of getting scammed on a vehicle type because of a cloned identifier, or maybe overpaying by tens of thousands of dollars because of a faulty appraisal, or, even worse, accepting terrible loan terms that just choke your cash flow for years. The true cost of ignorance in this arena is staggering, but hey, that is exactly what we are going to fix today. Here is our clear step-by-step roadmap for today. First, the equipment acquisition journey. Second, decoding the asset's DNA. Third, determining true equipment value. Fourth, financing to fuel growth. And finally, number 5, fast track to approval. We've got a lot of ground to cover, so let's just jump right in. Section 1, the equipment acquisition journey. Okay, let's dive into this and lay out the fundamental timeline of a smart purchase. Every single successful equipment purchase rests on 3 distinct pillars: identify the asset, determine its true value, and secure strategic financing. It sounds simple, right? But if you skip or rush literally any one of these steps, the entire structure just collapses. By mastering each of these 3 pillars, you empower yourself to negotiate massive purchasing decisions with absolute confidence. You're no longer just a buyer anymore. You are a strategic investor. Let's break down that first pillar. Section 2, decoding the asset's DNA. Look, before you even think about the money, you have to verify exactly what piece of equipment you're actually looking at. It's honestly incredible how much information is packed into a simple string of letters and numbers. Based on data from Carfax Canada, a vehicle's VIN is essentially its unique 17-character DNA. You can usually find this right on the dashboard, under the hood, or stamped on the front end of the frame. Here's how it breaks down. Position 1 tells you the country of manufacture. 2 is the manufacturer, and 3 is the vehicle type. Characters 4 through 8, those detail the brand, body style, and engine. Position 9 is a security check digit. Character 10 is absolutely crucial. It's the exact model year. 11 is the assembly plan, and those final digits, 12 through 17, are the unique serial number. It's the literal biography of the machine. Now, why does decoding this matter so much? Because decoding the VIN prevents disastrous mistakes. Imagine buying what you think is a pristine SUV, but then the VIN decode reveals the factory originally built a truck. No way, right? But it happens. That is a massive red flag for fraud or VIN cloning. Verifying the VIN ensures that the vehicle history report actually matches the physical machine sitting right in front of you. It's your first line of defense. Section 3, determining true equipment value. Okay, once you know exactly what the equipment is, we move to the next critical phase, which is figuring out what the machine is actually worth out there in the real world. So the crucial point is captured perfectly in this quote from expert Nathan Basil. The most expensive appraisal is the second one. Doing the appraisal right the first time saves you thousands of dollars and endless frustration. A major trap a lot of buyers fall into is thinking that book value or depreciation value is the same as market value. Let me be clear, it absolutely does not equal market value. To get the numbers right, you have to use the right definitions. Now, this is the gold standard definition from the American Society of Appraisers, which we pulled from our ThomasNet source. Fair market value is the price agreed upon by a willing, knowledgeable buyer and seller, with neither party being forced to act. Matching your exact situation to the correct value level is vital. If you tell a lender or the IRS you have the fair market value, it has to strictly adhere to this exact definition, assuming normal market conditions and reasonable knowledge from both sides. But, what happens when conditions aren't perfect? Let's contrast that with orderly liquidation value. This assumes the seller actually has a reasonable amount of time to find a purchaser. On the total other end of the spectrum, you have forced liquidation value. This means the seller has a real sense of immediacy. They have to sell right now, usually at a public auction. Time constraints and urgency drastically alter an asset's recognized value. Knowing which value a seller is operating under gives you massive leverage in your negotiations. And because these definitions are so strict, you really can't just guess. Hiring a certified professional appraiser is an absolute necessity. Whether you're dealing with buy and sell agreements, securing a loan, or doing tax planning, a certified appraiser provides the court compliance and unbiased, realistic values you need to protect your business interests. Seriously, don't cut corners here. Section 4, Financing to Fuel Growth. So we've identified the asset. We know its true value. Now we need to stop looking at financing as just an annoying cost and start viewing it as a strategic tool to scale your operations. For this part, we're pulling some great insights from the Pterodactyl Capital Equipment Finance Playbook. They highlight that strategic financing is really all about preserving your working capital. Instead of draining your cash reserves to buy a machine outright, you keep your money liquid for daily operations and those unexpected emergencies that always pop up. Plus, financing unlocks massive tax advantages, like the Section 179 deduction. This can actually allow your business to write off the full purchase price of qualifying equipment in the exact same year it's placed into service, entirely without that huge upfront cash outlay. Let me illustrate the incredible ROI, return on investment, that proper financing provides. Imagine acquiring a $150,000 excavator. If you finance it, you have predictable monthly payments. But that excavator allows you to take on larger jobs, generating, let's say, an additional $15,000 per month in new project revenue. That new revenue quickly outstrips the monthly financing cost. The machine is essentially paying for itself while actively growing your business footprint. That light bulb moment right there, that is what separates struggling contractors from industry leaders. And this brilliantly illustrates your main payment paths. With a lease, the pros are lower payments and flexible terms, but the con is you usually don't own the equipment at the end. A loan helps you build equity and eventual ownership, but it usually means higher payments and a down payment is needed. Cash means zero interest and immediate ownership, but the huge con is it totally depletes your working capital and you completely miss out on the financial leverage we were just talking about. Choosing the right path here depends entirely on your specific business goals. Section 5, Fast Track to Approval. So, you've chosen your path. Now how do we make it happen quickly? Because in the contracting world, speed isn't just nice to have. Time is literally money. To get approved fast, you need to know the test before you take it. Here is exactly what lenders are looking for. They want to see stability, ideally 2+ years in business. They need strong personal and business credit. They require crystal clear details about the equipment, make, model, and condition. And finally, they want to see your financial health, 2 years of tax returns, profit and loss statements, balance sheets, and your last 3 to 6 months of bank statements. All right, here is your actionable checklist to cut straight to the front of the line. Step 1, gather your financial documents early. Step 2, get a clean, highly detailed dealer invoice. Step 3, prepare that complete financial package we just discussed. Step 4, have personal IDs ready to go for any owner with 20% or more equity. The real secret here? Do all of this before you even find the machine. Having these items ready saves critical days when another buyer might be eyeing the exact same piece of equipment. Finally, seriously consider using an expert equipment finance broker. Why? Because going from bank to bank yourself takes massive amounts of time and it results in multiple hits to your credit score. A specialized broker takes your single, perfectly prepared application and shops it across a wide network of banks and independent lenders. They know the exact appetites of different lenders, efficiently matching you to the best possible partner and securing better terms for you, entirely without the headache. So, are you ready to apply this blueprint and execute your next massive equipment acquisition with absolute confidence? We've decoded the asset, we understand exactly how to command a true appraisal, and we know how to leverage financing to actually scale your operations. The playbook is right there in your hands. The only question now is, what are you going to go out there and build with it? Thank you so much for joining me on this explainer. Keep learning, keep growing, and I will see you next time.